Once again, natural resources at the center of the biggest deal in the world, probably the most important meeting that happened last weekend between China and the U.S. on trade. And what headline do we get out of Reuters yesterday? U.S. customers should get Chinese rare earth permits more easily after trade truce, say sources. So it seems to me that part of this deal that happened over the weekend in Geneva, Switzerland, was rare earths. And hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli. So let's take a look at this article. Rare earth export permits for U.S. customers are likely to have an easier time getting approval from Beijing after Monday's trade war truce. However, a complete removal of the restrictions is unlikely, according to two sources in the industry in China. China added 7 rare earths and related items to a control list in April as part of its retaliation against U.S. tariffs. The decision means exporters need to apply for licenses before selling outside China. While the decision applied to all countries, the likelihood of U.S. customers receiving export licenses during the trade war looked unlikely. Elon Musk said last month Tesla was in talks with Beijing over licenses for its Optimus robots. The truce announced on Monday could see the Ministry of Commerce expedite approvals, which in theory take 45 days, and even grant licenses to U.S. customers soon, according to two sources in the industry who are granted anonymity given the sensitivity of rare earths in China. Quote, "We are expecting to see an acceleration in the issuance of the required export license, and exporters with clients in the U.S. might get a license soon," end quote, said one of the sources. However, China is unlikely to remove the export controls because they form part of a broader package of measures designed to give Beijing greater control over various critical minerals where it dominates the mining or processing, they added. And then we have this article that came out this morning, so the following day. Chinese rare earth firms ask for official clarity on U.S. exports. So the Chinese firms are now asking for clarity, and this is Bloomberg via mining.com. Chinese rare earth exporters are asking the government to clarify whether they're allowed to sell to the U.S. after Beijing and Washington called a ceasefire in their trade war. In addition to the dramatic cuts to tariffs announced on Monday by both countries, China said it would suspend or cancel its non-tariff countermeasures imposed on the U.S. since April 2nd, an apparent reference to Beijing's addition on April 4th of 7 rare earths to its export control list. Numbering 17 in total, those are elements vital to high-tech and defense manufacturing, and removing the restriction was a priority for U.S. negotiators. So it sounds like rare earths were playing a pretty major role in these massive negotiations here. This beat just continues to be interesting, and we have a couple of follow-up stories as well that I want to touch on. China's rare earth exports drop as trade war crimps supply. This is Bloomberg News via mining.com. Chinese exports of rare earths dropped last month after the government tightened permits in order to regulate the supply of critical minerals to the United States. Overseas sales fell 16% from March to 4,785 tons, China's Statistics Bureau said on Friday, although that was still higher than the year-ago figure. So they came down a bit, but when you look at the chart, there doesn't seem to be, as far as China rare earth exports that they have here on this Bloomberg article, nothing out of the ordinary. If anything, they seem to be exporting a healthy amount, even higher than, say, 2021, 2022, and even 2023. Just last year, it spiked up at this time of year. So interesting in that front. And finally, China's rare earth curbs have changed psychology at U.S. firms. This is also Bloomberg News at mining.com. China's weaponization of rare earths in its trade war with the U.S. will spark a greater focus on American supply security for critical minerals, according to MP Materials, the only U.S. miner of the key materials used in smartphones and defense applications. And we have a quote from Chief Executive Officer Jim Litinsky, who said on an earnings call on Friday, quote, "Regardless of how trade negotiations evolve from here, the system as it existed is broken, and the rare earth Humpty Dumpty, so to speak, is not getting put back together," end quote. Scrolling down a bit, companies including Ford Motor Company have warned of shortages, and U.S. negotiators had hoped to address rare earths in their Geneva appointment with Chinese officials, according to people familiar with the matter. So that was also written on May 12th. And we have another quote from Latinsky, quote, "The idea that there was a threat that has now been utilized has really changed psychology, I think, from everybody across the board. My impression from conversations with the Department of Defense is that there is a full-on recognition that we can't be reliant on Chinese magnetics for national security purposes. For years we have warned that the global rare earth supply chain was built on a single point of failure. With China's sweeping tariffs and export restrictions, that geopolitical fault line has now become a commercial reality." End quote. Indeed, it has gone from an abstraction to a physical reality, it seems, when you have Ford Motor Company, potentially Tesla, out there waving their hands saying, we need these rare earths and we might have a problem here. On China's side, kind of an interesting side story. China launches campaign to crack down on strategic minerals smuggling. And this is Reuters via mining.com on May 9th, so before the weekend. China has launched a special campaign to crack down on the smuggling of strategic minerals, a Commerce Ministry statement showed on Friday. Since China imposed export controls on strategic minerals such as gallium, germanium, antimony, tungsten, and some rare earths, some overseas entities have colluded with domestic lawbreakers to continuously renovate their smuggling and export methods in an attempt to evade crackdown, the statement said. The campaign urges government departments to target typical evasion methods such as false reporting, concealment, smuggling, and third country rerouting, the statement said. So, also cracking down at the same time on illegal exports out of the country. And finally, just to round off our comprehensive coverage here of the rare earths situation, MP Materials swings to quarterly loss on rising production costs. So this is Reuters via mining.com. So MP Materials is losing money in part due to rising production costs and interest expenses, though results met investors' expectations. That kind of brings up a whole other issue. Bond yields, instead of falling once again with the market going higher, bond yields went higher. We're going to see that in the metal prices section. But it seems to me that Scott Bessent, the Treasury Secretary, is in a bit of a bind with the bond market because when the stock market went lower, bond yields went higher. And now when the stock market goes higher, bond yields go higher. So I have Jeffrey Christian on the show this episode of CPM Group. We discuss this situation actually with gold, with the bond market, also what's happening out of China, and how much China is actually influencing the gold market now, and if this is changing, and how China stacks up against the United States in terms of gold, as well as a very bullish forecast on silver and some promising words about copper and nickel. You don't want to miss that. So a wonderful interview with Jeffrey Christian this episode, as well as coming up on the Spotlight. We have Chris Dornbos, CEO of E3 Lithium out of Alberta, who, if everything goes to plan, would in theory be able to produce a significant amount of Canada's lithium needs. So all very interesting. Now let's continue with gold here. So we had a pullback on news of this deal in Switzerland between China and the United States. And it kind of got overstated, as Jeffrey points out. We're down about $250 from the high around $3,500. It doesn't actually seem like that big of a deal. So turning to gold, a couple of interesting stories here. JP Morgan says gold could hit $6,000 when Trump's term ends. This is by a staff writer at mining.com. As it says here, this scenario, according to its analysts, could realistically occur with just a small allocation away from U.S. assets under the current macroeconomic climate. I also discussed this with Jeff, this notion of are hedge funds and investors and everyone, are they underexposed to gold in his view? How does he see allocations, so to speak, and the reality of this issue? As it says here, even with 0.5% of foreign-held U.S. assets reallocated to gold, that would result in 18% annual returns and eventually send prices to $6,000, the bank wrote in a note on Wednesday. Also interesting, and we have a poll from Gallup, also by a staff writer at mining.com. Gold overtakes stocks as second favorite long-term investment, according to a U.S. poll. It almost sounds unbelievable. Let's see what it says here. Gold has surpassed equities as a second most popular long-term investment choice amongst Americans, according to the latest poll by Gallup, a Washington, D.C. based analytics firm. The poll was conducted during the first 2 weeks of April to gauge investor sentiments around the time the Trump administration announced its sweeping tariffs, which evidently led to a massive sell-off in stocks. Perhaps the timing of the poll also had something to do with it. In Gallup's annual poll, around 23% of U.S. adults now prefer bullion as their go-to investment, a 5-point rise over last year. The increase takes gold's popularity back to near the same level in 2023, when high interest rates and geopolitical uncertainty drove investors to the metal. Now, interestingly, when you look at the chart here, very interesting article on mining.com, real estate is considered by 37% of the public to be the best long-term investment, and then you see gold at 23%, overtaking stocks, which are now at 16%, and then you have savings accounts and CDs at 13%, then you have bonds at 5%, and cryptocurrency at 4%. So quite an interesting poll there. You can read the whole thing on mining.com, and continuing on the gold front, China keeps adding gold to reserves as challenges stack up. This is Bloomberg News via mining.com. China expanded its gold reserves for a 6th straight month in April, underlining its push to boost holdings of the precious metal as prices trade near a record and the trade war rumbles on. Bullion held by the People's Bank of China rose by about 70,000 ounces last month, according to data on Wednesday. In the latest 6-month span, volumes have climbed by close to 1 million ounces, or about 30 tons. And you do the math on that, that's about, $3.5 billion of gold in the last 6 months. And scrolling down a bit, in China, there have been signs investors are piling into gold, with volumes on the Shanghai Futures Exchange surging to a record in recent weeks. The voracious onshore appetite has also seen the PBOC issuing fresh quotas for commercial banks to import bullion. And this is also quite interesting. Central banks have increased their gold purchases roughly 5-fold since 2022, after a freeze on Russian reserves, according to Goldman Sachs Group, which has been among the most vocal bullion bulls in recent months. The trend is likely, quote, a structural shift in reserve management behavior, and we do not expect a near-term reversal, end quote. So quite something to hear. And one more on gold here. Shanghai Gold Exchange to expand warehouse network to Hong Kong. This is Bloomberg News via mining.com. The Shanghai Gold Exchange plans to expand its warehouse network to Hong Kong, helping to raise the profile of its yuan-denominated products, including for the precious metal, beyond mainland China. The new vault will be operated by a subsidiary of Bank of China, according to people familiar with the matter, who requested not to be identified as the information is private. The timeline for the move is not yet clear, they added. At present, there are 2 such warehouses in Shanghai, plus a third in Shenzhen, just across the border from Hong Kong. The People's Bank of China said last month it supported such a move without providing a location. The central bank indicated the initiative would promote yuan-denominated benchmarks for the Shanghai Gold Exchange's products, reflecting Beijing's push to exercise more influence over commodity pricing. A representative at the exchange declined to comment. Bank of China didn't immediately respond to a request for comment. So interesting. And also on the precious metals front, Pan American signs $2.1 billion deal to buy Mag Silver. And wait till you hear what Jeff has to say about silver. He gives a little nugget there at the end of the interview on silver that you don't want to miss. Also, I mentioned last week this report out of Africa Intelligence that Barrick Mining CEO, no longer Barrick Gold, they officially changed that last week, that Barrick Mining CEO Mark Bristow was preparing his secession, scheduled for 2028, and we got an article in the Financial Times that is confirming this. Barrick Mining formalizes efforts to find successor to CEO Mark Bristow. And as he says in the article, quote, there is board involvement in the process, end quote, Bristow told the Financial Times, adding that the CEO succession planning efforts were, quote, more formal now, end quote. He was speaking on Wednesday as Barrick, previously called Barrick Gold, reported net earnings of $474 million in the first quarter of 2025, a 60% increase on the same period a year ago, thanks to record high gold prices. So we mentioned it on this show last Tuesday, and it was confirmed on Wednesday. Interestingly, also Mark Bristow with a story in Reuters, Barrick CEO says he does not know where Mali is keeping its confiscated gold. And this is Reuters via mining.com. In an interview about the long-running conflict with authorities in the West African nation of Mali, Brisso said the government there had walked back on an agreement to settle a tax dispute 3 times, and called the jailing of Barrick employees in the country a human rights violation. Quote, "You have 4 executives from a Western world company incarcerated, which can only be described as human rights abuse," end quote, Brisso said. He said that the jailed executives have worked harder for Mali than the people who are currently leading negotiations for its government. Quote, "We don't know where the gold is. It is allegedly in secure custody, but we don't know that," end quote, he said. Scrolling down, when asked whether Barrick could look for a possible buyer for the asset, Brisso, who has overseen the mine's operations for nearly 2 decades, said it was, quote, "a controversial question, as very few people will be able to run the mine. It is one of the biggest mines in the world. It is very complex, and nobody is prepared to go into Mali," end quote, he said. And also in Mali, to Brisso's point, we have more security issues. Mining convoy attacked in Mali on road to Allied Gold's Sadiola mine. This is Reuters via mining.com. A convoy transporting heavy mining equipment from the Malian capital, Bamako, to Allied Gold's Sadiola mine came under attack in the Kays region over the weekend, 2 people familiar with the incident told Reuters late on Tuesday. The attack points to expanding security risks and related additional costs facing mining companies operating in military-led Sahel states that are struggling to contain Islamist militant groups. While government and military convoys more frequently come under attack in Mali, attacks on mining equipment have until now been rare. The CEO of Canadian gold miner Fortuna this month told Reuters that increased security concerns due to jihadist threats were among the reasons the company recently decided to exit Mali's neighbor, Burkina Faso. In Sunday's attack, 2 large trucks were set alight, an excavator was damaged, and 2 pickup trucks were stolen, one of the sources familiar with the incident said. No group has yet claimed responsibility for the attack. The equipment belongs to the local Caterpillar dealer Nimba and had been leased to the subcontractor Moda Engel, which operates at Sadiola's quarry, the sources said. 8 people present, all employees, were unharmed in the attack, which the sources said was disrupted by soldiers from the Malian army who had been nearby. Wild situation there in Mali. Very interesting as well. Niger security forces search Orano offices and seize phones. This is Reuters via mining.com. Security forces in Niger have searched the offices of uranium miner Orano's local subsidiaries, seizing phones and equipment, 2 sources told Reuters on Tuesday, months after the French company said authorities had seized control of its Sommer mine. One of the sources, who is close to Orano, also said local director Ibrahim Kourmo had been arrested. Orano said it had very limited information on the situation because it had lost operational control of its subsidiaries in December. Quote, "On Monday, May 5th, it appears the Nigerian law enforcement officers intervened at the headquarters of Sommer, Cominac, and Orano mining Niger subsidiaries in Niamey, with equipment seized," end quote, the company said in a statement to Reuters late on Tuesday. Quote, "We are very concerned about the situation as we have not been able to contact the Orano representative in Niger at this stage," end quote. So more rule of law concerns in the Sahel. Meanwhile, we got a story from the Tehran Times. Niger welcomes imports of Iranian mineral products, according to an envoy, and there must be some concern out there with all of Niger's uranium and increased mineral trade between Niger and Iran. One imagines that would create concern in Washington. Finally, we have a story from The Diplomat. Myanmar junta boss to attend World War II victory parade in Moscow. Senior Gen Min Wang Lang also made 5 trips to Russia since the February 2021 coup. So this would seem to suggest that Russia is backing the military junta in Myanmar. As we've been following there, they're a major supplier of rare earths to China where they are processed. So interesting development there. Full circle, really, on our whole introduction here. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. You can find us on Instagram at The Northern Miner and on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to Chris Dornbos, CEO of E3 Lithium, for this week's Spotlight. Joining us today, I'm very pleased to welcome to the Northern Miner podcast, Chris Dornbos, Chief Executive Officer of E3 Lithium, for this week's Spotlight. Chris, welcome to the show.
Yeah, thanks for having me.
It's a pleasure to have you, Chris. I brought up the website here of your company, and when I saw it, I remembered. There's quite a few stories in the past on E3 Lithium, and it's a pretty original project out of Alberta that is working with lithium. So, for those that are unfamiliar with E3 Lithium, could you give us a little bit of background on the company and what you guys are up to?
Yeah, absolutely. We're a lithium development company focused on repurposing a very historic asset in Alberta. It's called the Leduc. It was discovered in the 40s by Imperial Oil and really started what I would call the oil rush into the province and into Western Canada. It's been producing oil since the 40s and in the area that we're focused on since the 60s. The oil is pretty much produced off, and what's remaining is a lithium enriched brine or salt water. And so since 2016, we've been looking to repurpose this asset and turn it into a lithium producer as it's at the end of its sort of oil cycle and convert it into the lithium world. A large part of that has been on the technology development side of things because the aquifer is well understood, well known. It's been producing this water for 70 years as a co-production of oil. So we know how to move the water in and out of this aquifer. But we are looking at the extraction side. And that's really where the sort of tipping point happened for the company and what we're advancing to get this thing commercial.
Okay, excellent. So ultimately, as you say, there's an aquifer there. And so would it be fair to say that this is, for the most part, a processing type project? And, you have a lithium deposit here, but it's basically in brine, salt water.
Yeah, exactly. The aquifer is very well understood. So the focus for the company, therefore, has been on developing what the industry is now calling direct lithium extraction. But really what it is just the primary extraction of lithium from water. And we've been working on a technology and a process since 2017. And it's taken a path of evolution as they always do. And now where we're at is that the technology that we've been able to develop is, and what we focused on is along the processing side. So how the machine will operate. The other piece of the technology is the sorbent, which is the extraction media, the stuff that goes in the tanks that the lithium sticks to. And we've developed our own, but over the years, big chemical companies and other companies have developed this material. And we made the shift, I'd say 2 or 3 years ago, to just use a third-party sorbent or this chemical, this bead, because they're readily available now. And because we would have to build that sorbent manufacturing facility first. And so now what the company has been focusing on going forward is demonstrating this at a scale where we can get the project commercial. And a large part of our activities right now have been scaling this up. And this is a normal course development in proven technologies and new technologies, is that you demonstrate your ability to operate at a larger and larger scale. And it's attuned to like a hard rock mine that might do a big test pit, take a bunch of material, send it off, understand how it crushes, understand how it gets processed into the commodity. That's effectively the same path that we're taking. It's just a water source rather than a rock source.
Very interesting. And so this path to commercial, as you call it, is this for people that are looking at the lithium industry from a distance? Like, is this in a sense, are you ultimately providing basically an alternative to, say, processing in China, where a lot of the lithium is produced?
I think that's one of the big advantages to E3 is that we can keep the supply chain local. The process that we're developing produces at the end of it a battery quality lithium salt. Our first plant that we're looking to build will do carbonate. Carbonate's used in different cathode chemistries like lithium iron phosphate and something we would call mid-nickel cathode. And those two batteries are in a significant rise in terms of their use case across the world. The estimate's about 70% of the world will consume carbonate-based batteries by, say, 2030 or so. And so we're focusing initially on a carbonate salt, but right now, around 70% of that material gets produced out of China. Now, it doesn't necessarily get mined there. It's coming from Australia. It's coming from South America, mainly Africa as well. And it's being shipped over to China for processing, and then it's sold to the world as a salt or as a cathode. And so we can eliminate that by producing the material here. And our process lends itself to that. So our first step, we extract it from the brine. We make a lithium chloride. It's just lithium salty water. Sodium chloride is salt water. So this is lithium chloride. Then we remove some of the water. We clean up some of the other impurities in there. And we get it to pretty close to battery quality as a lithium chloride. And then we add a chemical called sodium carbonate, which is just something you would bring in as a reagent. you mix it with lithium chloride, and that produces lithium carbonate. The byproduct of that is sodium chloride. So when you look at this full process, we are able to, without a lot of energy, and I think that's the most important part of this, is the energy intensity and the environmental impact to get from a raw lithium source to a final battery grade product ready to go into battery plant is much smaller than, say, a traditional hard rock mine or a salar, because of the processing ability of this direct lithium extraction. And so then we've been able to also reduce environmental footprint a little bit, because this is not an open mine or a salar. We have a producing set of wells that collect the brine to a central facility, and we do the extraction, we put the brine back down. And the only real significant waste product that the process produces is salt water. And because the water coming out of the ground is salty, we can just put it back into the brine stream. And that enables us to have a closed loop system. And even our water, every process like this uses water. Our water will be sourced from internal recycle streams and from the brine itself, meaning we won't have to source any external water, and we don't put any water back into the environment. We don't have tailings ponds or that sort of thing. So the process looks very, very tight in terms of its environmental, its energy consumption, all of those things. And so when you look at this, therefore, on a global stage, we have a very good looking project in a jurisdiction that permits projects just like this, because we operate just like an oil and gas project. We have a well, we have a pipeline, we have a facility. We've been permitting projects that produce oil out of this aquifer that also brings this brine to surface for 75 years in Alberta. So there's a very clear path to get this thing permitted. And I think that's another advantage when we look at this is that time frame. And, looking at submitting all of our permits this year, anticipating having them back sometime later next year, which puts us in one of the top projects that can get commercialized in terms of time frame in North America and somewhat in the Western world as well.
Well, it all sounds quite promising, Chris. So in terms of scale, do you have all the brine that you're ever going to need, or the lithium deposit, so to speak? Are you going to need to source it from external sources at a certain point? Can you produce, in a sense, what Canada needs? How does that all look?
Yeah, it's very interesting. The size of this aquifer is phenomenal. And it was a world-class oil and gas producer in its heyday because of its ability to move fluids. And you can think of it like a big sponge 2.5 kilometers down, and you're producing the brine out of it. And you can also put the brine back down. Our first project, and we put this out, sort of our scaled up process, the first plant, phase 1, will be 12,000 tons of lithium carbonate, and that can scale up to about 36,000 tons roughly. And then you would build another facility. And our estimates right now, based on the amount of brine that is in the aquifer, is that we can probably do 4 or 5 of those 36,000 ton facilities. And so you're looking at about 150,000 tons of product a year with about a 50-year mine life. And your question about Canada's consumption, if all of these battery factories that we're looking to build get off the ground, we're talking about 200,000 tons plus minus of lithium salts required. So E3 can produce a significant portion of Canada's lithium, but the market is obviously much bigger in the United States. It's much bigger in Europe. And so there's obviously some natural partnerships. And I think, looking at the global stage right now, Europe has much less resources than they do capacity and demand for lithium in their batteries. And so I think, our eyes right now are on the Europeans, because they are out there right now looking for lithium for their growing battery industry. And even if you look domestically in North America, a lot of the companies that are building batteries are the Japanese and South Korean battery companies. And so I think there's some really good opportunity there, because everybody is looking for a local supply.
It sounds very exciting. So as we wrap up here, Chris, if you could briefly describe just kind of where you see this going, and ultimately, what is your message for investors here?
Yeah, I appreciate that. I think the big thing that E3 has been focusing on is getting this first facility going. Our belief is that we have the ability to move quickly, and time is an asset. And when you look at the world right now, and sort of, we won't get into what's happening outside of Canada, but everybody is familiar with the trade wars that are happening. And I think building domestic supply, having your own sources of these things, is becoming more and more important. And I think that sets the stage for E3 because of our ability to move quickly and because of the scale. And I think the next 12 months for E3 are going to be a very exciting time because we turn on our demonstration facility. And there's 3 stages, and I won't go into the detail, but it's all on our website and our news announcements. Those 3 stages lead us to a full commercial size column operating, which basically de-risks the whole project from the technology side of things. And then we'll be working on engineering and permitting, and we aim to have this project ready to start construction in 2026. And I think that time frame and our ability to move that quickly, governed by following all of Alberta regulations and permitting and not skipping any steps and still building a project that has the high standards that the world has come to expect from Canada in terms of our environmental protection and the social license that comes along with that, and doing all of the things with due process, we're still able to move very quickly and get things permitted in roughly about a 12 to 18 month time frame. And that really puts us on the top of the pile. And I think the world is still moving electric, the pace of which is sort of fluctuating, but this is normal. And we're seeing more and more developments and installations of these batteries across the globe. And I think the future is very bright for batteries, for the use case for battery, and therefore for local supply of the raw materials going into it.
Chris Doornbos, CEO of E3 Lithium, thank you for joining us and sharing all of the interesting developments you're working on in Alberta.
Yeah, thanks for having me on today.
And thank you once again to E3 Lithium for sponsoring this week's episode of the Northern Miner Podcast. Turning to the news, we have one story here from the FT before we go to mining.com, just to set the table on this copper story, which seems to be flying a little bit under the radar. A rush of copper to U.S. because of tariff threat creates shortages in continental Europe. This is Camilla Hodgson at the Financial Times. The rush to get copper into the United States ahead of possible tariffs has created shortages and price dislocations for the red metal in continental Europe. The region's spot market has been hit by a lack of available copper for immediate delivery, analysts at Argus Media said. This has pushed up premiums to record highs on the continent, which are paid on top of benchmark prices on the London Metal Exchange, Europe's biggest hub where much of the stocks are stored. The premium for copper delivered to Germany rose to $250 per ton, while those to Livorno and Rotterdam hit $180 per ton at the end of April, according to data group Fast Markets. Although markets have calmed since U.S. President Donald Trump's Liberation Day announcement, the record premiums highlight the persisting distortions caused by the threat of tariffs in a sector vital for industry. Stocks in China have also rapidly declined recently because of the flows to the U.S., where prices and warehouse supplies have soared. Copper prices on the LME, the world's benchmark, were trading at about $9,400 per ton on Friday, about $700 per ton cheaper than on the U.S. COMEX exchange. And Ronan Murphy, head of copper pricing in Europe at Argus Media, said, quote, "All buyers are exposed and we're worried about getting extra supply if they need it." End quote. So very interesting. Let's turn to the website. And so here more on the copper situation. This is Bloomberg News via mining.com. China's record copper ore imports offer relief amid shortage. So apparently the tariffs led to a shortage in Europe and China. Chinese copper concentrate imports climbed to nearly 3 million tons last month, a record that's likely to ease price pressures in the domestic market and offer relief to smelters fighting for the availability of feedstock. Spot treatment charges at global smelters are deeply in the red, an unprecedented collapse caused by a rapid expansion in capacity colliding with a global shortage of ore. The heaviest concentration of plants is in China, where output of refined copper has hit all-time highs despite pledges to rein in production to rescue margins. In that context, China's ability to secure such a large amount of concentrate will be a welcome boost to the industry. Domestic demand for copper has proven remarkably resilient in a slowing economy, while competition for supply has heated up as the U.S. draws more metal ahead of tariffs threatened by the Trump administration. Quote, "Chinese smelters are better prepared this year," end quote, said Li Chengbin, an analyst with MySteel Global, and have fixed more volumes on long-term contracts. He said they've been helped by the availability of additional ore from the mega mine run by PT Freeport Indonesia, which got export approvals in March after a 2-month moratorium. The production halt at Glencore's smelter in the Philippines, a casualty of the collapse in processing fees, would also have freed up concentrate for China. Treatment charges, meanwhile, continue to plummet as demand from smelters around the world outpaces supply. Spot fees have been negative since December, meaning plants are paying to process ore, and on Friday hit minus $57.50 a ton, down from minus $52.80 at the end of April. So smelters in China are paying to process ore. Unbelievable. Reminds you of when we had the negative oil price. Another headline, Nippon Steel exec headed to Washington next week in push for U.S. steel deal. So Nippon Steel, U.S. steel deal coming to a head. Continuing on, BYD and Tsingshan scrap plans for Chile lithium plants. This by Cecilia Jamasmi at mining.com. Chinese carmaker BYD and metals giant Tsingshan have abandoned plans to build lithium processing plants in Chile. Local newspaper Diario Financiero reported on Wednesday. BYD has already filed its withdrawal notice with the National Assets Ministry. Tsingshan, through its affiliate Yongqing Technology, informed Chile's economic development agency Corfo that it will no longer pursue its lithium battery project. Corfo confirmed the withdrawal, noting that Tsingshan was not legally incorporated in Chile. Both companies were selected by Corfo in 2023 as strategic investors to develop value-added lithium products such as cathodes and batteries. Scrolling down, a combination of plunging lithium prices, global market instability, and bureaucratic delays derailed both initiatives before contracts could be finalized. You know, another huge story that we haven't even gotten to is lithium is below $9 a kilogram. I believe it's $8.96, as we'll see in metal prices. So that probably also has something to do with it. Continuing on, Talon Metals shares surge on historic massive sulfide discovery. This is by a staff writer at mining.com. Talon Metals announced on Monday it has made a historic discovery at the Tamarack Nickel Copper Project in central Minnesota. Shares of the company soared to the highest in almost a year. The discovery is highlighted by a massive sulfide intercept with a cumulative length of 35 meters, the longest ever recorded on the property. The previous record was 23 meters from drilling in 2022. This intersection, for which assays have yet to be graded, represents a defining moment for the Tamarack project, says Talon's Chief Exploration and Operations Officer Brian Goldner. Quote, in my 19 years working on the Tamarack project, I've never seen anything like this, end quote, Talon's Goldner said in a press release. Quote, it confirms what we've believed all along, that Tamarack is a truly world-class system, end quote. Talon is currently the majority owner and operator of the Tamarack project with Rio Tinto as its joint venture partner. Continuing on, U.S. to fast-track Utah uranium permit. This is Reuters via mining.com. The U.S. Interior Department said on Monday it will fast-track environmental permitting for Anfield Energy's proposed Velvet Wood uranium mine project in Utah to boost President Donald Trump's effort to ramp up domestic energy production. As a result, the project's environmental review will be completed in just 14 days, the department said in a statement. 2 weeks. Incredible. Such studies typically take years because of the potential environmental effects of uranium mining. And we have a quote from Secretary of the Interior Doug Burgum. Quote, America is facing an alarming energy emergency because of the prior administration's climate extremist policies. President Trump and his administration are responding with speed and strength to solve this crisis. The expedited mining project review represents exactly the kind of decisive action we need to secure our energy future, end quote, he said. And continuing on, the metals company to raise $37 million for seabed exploration. This is Blair McBride at the Northern Miner. Undersea critical minerals explorer The Metals Company has lined up $37 million US for seabed exploration. Shares rose. Led by Hess Capital Chief Investment Officer Michael Hess and SAF Managing Partner Brian P. Spraga, the registered direct offering will fund TMC's commercial development plans and is expected to close by May 22nd, TMC said on Monday. Proceeds are expected to be sufficient to fund operations until a commercial recovery permit has been issued, the company said. Quote, we're thrilled to welcome Michael Hess as a strategic partner, end quote, TMC Chairman and CEO Gerard Barron said in a press release. Quote, he brings over 15 years of exploration and production experience as both an investor and operator, along with deep relationships across the United States, end quote. Continuing on, Norway's wealth fund to engage Rio Tinto South32 over environmental concerns. So as that headline from about a year ago said, ESG is dead, long live ESG. This is Reuters via mining.com. Norway's sovereign wealth fund, managed by Norges Bank Investment Management, has decided to actively engage with mining companies Rio Tinto and South32 regarding their environmental practices, the fund operator said on Sunday. The executive board of the largest sovereign wealth fund in the world said it arrived at this decision following a recommendation to sell its stakes in the companies from the Council on Ethics, an independent advisor appointed by the government of Norway. The fund owns an about 2.5% stake in Rio Tinto, 0.13% in Rio Tinto Limited, and a 2.6% stake in South32, according to LSEG data. And finally, U.S. judge halts land exchange for Rio Tinto copper mine opposed by Native Americans. This is Reuters via mining.com. A U.S. federal judge on Friday temporarily blocked the Trump administration from transferring land to Rio Tinto and BHP for a copper mine opposed by Native Americans, citing the Supreme Court's ongoing deliberations in the complex case. And we have a quote from U.S. District Judge Stephen Logan. Quote, "It is abundantly clear that the balance of equities tips sharply in Apache Stronghold's favor, and that even in the short term they have established a likelihood of irreparable harm should the transfer proceed." End quote. Those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market, which has been dramatic. For a little bit of context, the U.S. 10-year bond is yielding 4.45%. That is 0.09% higher than last week and edging towards that 4.5% mark. The UK 10-year gilt is yielding 4.66%. That is up 0.11% on the week. The Italy 10-year bond is yielding 3.71%. That's up 0.08% on the week. The German 10-year Bund is yielding 2.67%. That is up 0.14% on the week. And the Japanese 10-year bond is yielding 1.44%. That is 0.18% higher than last week. So long-term bonds continue to struggle here. We're going to discuss more about bonds and the gold market in my upcoming interview with Jeffrey Christian later in the show. Turning to precious metals, gold is trading at $3,257.80 per ounce. That is down $131 on the week. Silver is trading at $33.33 per ounce. That is down 19 cents on the week. Platinum is higher at $975 even. That is $22 higher on the week. And palladium also edges higher at $935.50 per ounce. That is $2 higher on the week. Turning to industrial metals, copper is lower at $4.56 per pound. That is 9 cents lower than last week. Iron ore edges sideways at $98.55 per metric ton. That is 36 cents higher than last week, so basically even. Aluminum edges slightly higher at $1.12 per pound. That is a penny higher than last week. Lead is slightly higher as well at 90 cents per pound. That is 2 cents higher than last week. Nickel is also higher at $7.06 per pound. That is 6 cents higher than last week. Tin is also higher at $14.46 per pound. That is 54 cents higher than last week. Cobalt is unchanged at $15.29 per pound. Lithium, a real head-turner, drops below $9 at $8.97 per kilogram. That is 38 cents lower than last week. Uranium edges slightly higher at $70.25 per pound. That is 45 cents higher than last week. And zinc is also higher at $1.22 per pound. That is 3 cents higher on the week. Zooming out, industrial metals catch a bid while precious metals take a breather. And those are your metal prices. Coming up, I'm very pleased to welcome back to the Northern Miner Podcast, Jeffrey Christian, managing partner at CPM Group. We discuss everything that's happening in gold, who has the biggest influence on the price, what is happening in China, what is happening in the U.S., is the world diversifying out of bonds into the gold market? And also, we discuss silver, nickel, and copper, which Jeff is bullish on, and much more. I hope you enjoy the conversation, and I will see you on the other side. Joining us today, I'm very pleased to welcome back to the Northern Miner podcast, Jeffrey Christian, managing partner at CPM Group. Jeff, welcome to the show.
It's great. I always enjoy talking with you, Adrian.
It's wonderful to have someone on with so much knowledge, decades really, in this industry, front row seat. So we've had a lot of drama this year in the gold market. It is getting a lot of headlines and we have a lot of records broken. There is discussion, as ever, in this much discussed market that the setting of the gold price might be moving east. So my first question for you is, who is setting the gold price? Where does the gold price get set?
The simple answer is everyone is determining the price of gold. It's a common question that people ask all the time. Our view is based on what we've witnessed over the last half century. The longer term gold price is determined by the supply and demand of physical gold, and the shorter term price is determined by shorter term investors. And you have seen an increase in the role of Chinese and Indian and Southeast Asian institutional investors, high net worth individuals, and smaller retail investors over the last 10, 15 years. And so the Shanghai gold price is much more important to the global gold price than it used to be. But so too is the Mumbai gold price. And you see much more activity coming out of China and to a lesser extent India in the global gold market. So they have more influence, but because of trade restrictions in both countries, the prices are not wholly representative of the global price. You have a much freer and open gold market in London, Switzerland, and New York and Singapore than you do in Shanghai. So Shanghai is more important in terms of volume, and it's growing in volume, but it's still held back by some of the regulatory restrictions that apply there.
Very interesting. So then, in terms of, say, volume, then, I assume that must have an impact. It stands to reason what you say. Everybody is basically setting the gold price. Fair enough. But in terms of volume, is China outpacing the United States in terms of, or say, the Shanghai Gold Exchange? Are they outpacing the COMEX or the LBMA in London in terms of volume?
No, the COMEX still trades much more than Shanghai. Shanghai is gathering increased volume and a growing market share, but COMEX is still the largest trading volume. And London still is trading, a fair bit of gold too. So, the average daily number of ounces in London is, 17, 18, 20 million ounces a day. That's still a substantial amount of trading that's going on there. But, in terms of volumes, if you look at just the futures markets, COMEX traded 6.4 billion ounces of gold last year, and Shanghai traded 2.4 billion ounces. So COMEX is still a much larger market. And what we see is a lot of trading on the COMEX from Chinese entities. So it's interesting, when you start saying, well, where's the influence? The reality is that a lot of Chinese institutional investors and high net worth individuals would rather trade COMEX because it's more liquid and more representative of the global price than their own domestic market. And I should point out the 2.4 is the Shanghai Futures Exchange, not the Shanghai Gold Exchange.
Right. And could you illustrate the difference, say, between the Shanghai Gold Exchange and the Shanghai Futures Exchange? Like, in a sense, where is the gold trading, or is it both? Is the futures basically just a paper sort of options market of sorts? What is the difference?
The Shanghai Futures Exchange is a futures exchange. So it trades an enormous number of commodities and other assets in the futures market. And the Shanghai Gold Exchange is really a physical market. So it trades more of the physical metal that flows through smelters, refiners, jewelry and electronics fabricators, scrap recycling, over and over again. So the Shanghai Gold Exchange is the physical gold market, and the Shanghai futures market is where a lot of the financial trading occurs. And, as you look at the markets, you see around the world that, the physical market is a fraction of the size of the futures market. And that's true probably in most commodities, but it's definitely true in gold and silver because of the financial aspect of those two metals as opposed to being industrial commodities.
Okay, beautiful. Thank you for explaining that. And so when there's a premium, say in the Chinese gold market, do you know if
Mhm.
that's in the futures? Is that where it is?
Well, there's a premium in both the physical market and in the Shanghai Futures Exchange. We look at it in terms of the Shanghai Futures Exchange versus COMEX. You could also look at it in terms of the Shanghai Gold Exchange versus London, because those two markets are more physical markets. LBMA is not so much we use the term physical poorly in the precious metals markets. The LBMA is a over the counter market. So it trades a lot of spot and nearby OTC trades, like 60% or so of the LBMA. The London gold is what they consider spot trades.
Okay, very good. And so finally, just to kind of wrap the bow on this point then, so when there's a premium, let's say in the Shanghai Futures Exchange,
Mhm.
uh, is the nature of the relationship of, say, gold being set by everyone, is there is an arbitrage to be done between the other exchanges? And so this eventually evens itself out, kind of theoretically, in terms of the quote unquote global price?
In a way, it shakes itself out, but like again, because there are certain restrictions on imports and exports and ownership in China, and to maybe not a lesser extent, India as well, those markets, especially China, tends to have a premium over, say, the London market or the COMEX. And that reflects the fact that you don't have a 100% free flow of gold into and out of those countries. So there tends to be a little bit of a premium, both, especially in Shanghai, like the SGE relative to the London price. You tend to see a premium, which reflects the stickiness and restrictions that apply in Shanghai that don't apply in London.
So, zooming out a little bit, in terms of the move we've seen in gold, I mean, last time we talked maybe 6 weeks ago about, say, how, the Polish central bank had bought a lot of gold, something like $9 billion worth in that neighborhood. Do you see central banks again as the main driver, or what was the main driver, in your opinion, of the latest move we saw in gold, say, from 2,900 all the way up to $3,500?
I think our view has been that it's private investment demand. Central banks have been buying a lot of gold, but they are more price sensitive. So, last year you saw central banks buying 40% less gold physically in terms of volume than they had bought in 2023. And it's interesting because the gold promoters will say, well, central banks continue to buy large amounts of gold. They're buying more than 1,000 tons a year on a net basis as a group. And that's true. But within the context of they're buying more than 1,000 tons a year, you saw a sharp decline, a 40% decline in the volume of gold that they were buying, about 14 million ounces in 2023, and they bought about 8.4 million ounces on a net group basis in 2024. Now, there are a couple things that affect that. One is the Russian central bank is using its gold reserves to help finance the government and the war effort. And so it's been buying and selling gold, which has kind of distorted those totals. So you really want to look at central banks excluding Russia to get a better picture. The second thing is that the price has risen. So the price of gold, the price of gold last year was up 23% from where it had been the year before. So if central banks don't say, I want to own or I want to buy X ounces of gold. They say, I want a certain percentage of my monetary reserves to be in gold. And my monetary reserves are denominated in dollars. So I want to buy X dollars worth of gold. If the price is 23% higher than it was the year before, and you're putting the same amount of dollars to the gold market, you're buying, 20% less gold than you bought before. So that's one of the factors. The other thing is that as the gold price rises, central banks say, I was a buyer at $2,000. The gold price averaged $1,952 in 2023, and it averaged $2,400 last year. So a lot of central banks are more value investors than private investors. And they say, I was a buyer at $2,000 in 2023. I'm less interested in buying at 2,400. If the price falls back to 2,000, I'll probably be a very aggressive buyer. This was last year, So now the threshold is higher because the market price has moved higher. But the central banks are more cautious buyers than private investors. So we look at the gold market last year and we see this 40% decline in central bank buying, but that was offset by, really like a 24% increase in private sector buying, which went from maybe 22 million ounces in 23 to about 37 million ounces last year. That's more like a 2/3 increase. So the increase in gold prices we saw last year and in the first 4 months of this year has primarily been driven by private investors and private investors around the world. You have not been able to say, oh, it's Chinese buying or it's Indian buying or it's European buying or it's North American buying. We have seen strong investment demand globally, really for the last 24 months now.
Very interesting. So on April 2nd, Liberation Day, when the tariffs came in, there was a surprise in the market that this was the discussion that the market was going down and usually Treasury yields should fall because there should be more demand for U.S. Treasuries as a safety.
Mhm.
Instead, the yields went up and also the gold price seemed to go up along with it. And so there was a kind of math that seemed to go on, maybe in your view, a simple math going, it's China that is now putting money into gold rather than treasuries in a sense, or even globally, there's a bit of a strike, let's say, on U.S. treasuries. What is your thought on that?
It was a global strike. I'm sure that there were some Chinese entities that were doing that. But, I think people overplay the idea that the People's Bank of China or the Chinese government are doing that. You have to understand that the People's Bank of China owns a tremendous amount of US dollars, mostly held in US treasuries. And if they want to strike on treasuries or sell treasuries, the person they hurt the most is themselves, right? So they'll sit there and watch other people get turned off by the US Treasury's behavior and drive the yields up on those treasuries and say, we're going to get blamed for this, but it's not us. What we saw on April 2nd was really a universal marking down on the credibility of the US government and the US Treasury. And it was really worldwide. And, it's interesting because you said, April 2nd and the announcement of all these tariffs came as a surprise to people. Well, it shouldn't have been a surprise because the guy was saying tariffs 40 times a day for 5 months, right? So everybody should have been prepared for it. But the fact that the US government was so stupid that it actually proceeded with that, with all of the risks that were obviously inherent, starting a trade war and jacking up tariffs to outrageous, irrational levels. The fact that the US government and Treasury actually went through with that caused people to say, oh God, this is bad. And the other thing is, like, by April 2nd, it was clear that the Trump administration was spending vastly much more money than the Biden administration and other previous administrations had done. So they were expanding deficits and they were increasing at a much faster rate U.S. debt growth. federal debt growth. And all of that's negative for Treasury. So it was, I'm not sure if it was a strike. It was just a recognition that the U.S. Treasury securities were less credible and less creditworthy than they used to be. It's like, if you guys are so dumb to do this, we've just lost a lot of respect for the U.S. Treasury.
Right. So they have to, in a sense, they have to second guess any assumptions they might have had previously. Now, you brought up investment demand. It sounds like it's grown remarkably in the last 2 years, as you're describing. There was this story on mining.com of a survey that says gold has surpassed equities as the second most popular long-term investment choice amongst Americans, according to the latest poll by Gallup, a Washington, D.C. based analytics firm. Now, that doesn't necessarily mean that's what they're doing with their money, but it's,
Right.
Their second most popular long-term, and like maybe that's just what they tell Gallup, because it seems unbelievable that this would be surpassing equities. So could you tell us a little bit about that? Because there's two narratives we hear, that gold isn't even on the radar of most fund managers, and then we see a poll like this Gallup poll on mining.com. So what is your sense? It sounds like it's a popular investment.
Yeah, we keep hearing marketeers say North American institutions haven't been investing in gold. We haven't seen that. We've actually seen, especially since April of 2024, so 13 months now, we've seen a lot of institutional investors in North America stacking up on gold. And some of them are buying ETFs, and those are like the novices. But other institutional investors are eschewing ETFs, and they're saying, no, I don't want to own the shares of an ETF that owns gold. I want to directly own gold, physical gold that's stored in a depository that I can own on an allocated or an unallocated basis. And we've seen that demand for physical gold growing really over the last several years in North America as well as in other parts of the world. And it has accelerated since April of last year, and it accelerated again in April of this year. And, one of the questions we have is what happens now in May and beyond, but it's not there. And in terms of the Gallup poll, I sometimes refer to an old Little Rascals episode where a guy says, what do you kids want in a diner? And they list all this food they want. And he says, well, how do you expect to pay for it? And they said, we don't expect to get it. You asked us what we wanted, not what we expect. I think that if you talk to a lot of investors in North America, institutional, high net worth, and retail, they would say, oh, yeah, I'm much more interested in gold right now than I am in equities. But that does not mean, as you said, it does not mean that they're actually buying it. And if you think about it, you have like 40% of the households in America that only have like $3,000 cash. So they could buy an ounce of gold and not have any money to live on. So one of the problems that you see in North America, and to a lesser extent in Europe, is the paucity of investable funds. Because if you go into the fractional gold coins, you're just paying such high premia that it doesn't really make sense. So I think that what the Gallup poll shows is a lot of people are aware that they probably should be investing in gold, but they don't necessarily invest in gold. Now, we do work for companies that provide precious metals to the retail markets around the world. And one of the things that we see in North America, and to a lesser extent in most parts of Europe, is that investors will say, I'd like to buy gold, but I can't really even afford an ounce, so I'm going to buy silver. So, we'll find that retail outlets will market gold, but sell silver.
Very interesting. And I want to go to silver in just a moment, but just to finish up on what you're saying then here, could we conclude that therefore we are not early in a sense on the gold trade? I mean, here we are at record levels. I mean, to just conclude something fairly straightforward, it doesn't seem like we're early.
We're not early, no. And it's interesting because people always say, "What inning are we in?" I'm not a spectator sports fan. I love playing sports, but watching other people playing sports, it just doesn't make sense to me. But I'm not big on sports things. But it occurs to me that we are in the top half of the seventh inning. And the reason I say that is that CPM Group has been projecting for some time that the gold price would rise and silver price would rise sharply in the first 4 months of this year and then come off some. They wouldn't go back to where they were, but they would come off some between May and August. Sell in May and go away applies to precious metals oftentimes seasonally over time, the same way it applies to equities. There are seasonal changes in fabrication demand and seasonal changes in investment demand that often cause prices to rise sharply in the first 4 months of the year and then come off in the middle part of the year and then start rising again in the final 3 or 4 months of the year. And we've been saying to our clients and to anybody else who wants to listen to us that we thought that the prices could peak in March or April and then come off, not going back to where they were. I mean, gold started 2025 at $2,662 an ounce. And it didn't go over 3,200 until the beginning of April. We've seen this massive sell-off that people are like freaking out over the last 2 days, and the price of gold is down to $3,250. In other words, it's higher than it has been at any time really prior to April. you know, and this massive sell-off. Is the bull market over? And our answer is no, the bull market's not over. On a cyclical or seasonal basis, we may see the price move sideways for the next several months, but the economic and political factors that have caused investors to buy outsized volumes of gold and silver are not going away. They're not being solved, and they'll be back. So, if you just look at the headlines today, the price of gold is off sharply because the U.S. government said, oh, we've reached an agreement on tariffs with the Chinese government. You haven't seen a lot of feedback from the Chinese government other than to say, oh, yeah, the U.S. seems to be caving and backing off from these absolutely ridiculous tariffs. The tariffs that the U.S. is imposing on China and China is imposing on the U.S. are still higher than they were prior to April 2nd. So that's not really solved. It's just papered over on a public relations basis. And those issues are still there. And the U.S. government will come back. It will regroup and make a new charge. So you can expect that, but it may be several months. I mean, the U.S. government is licking some wounds here because several of the things it's been doing are getting shot down and rejected, and people are standing up to them. So we think that you could see the prices come off, or they have come off. We think you could see the prices move sideways for several months before rising again toward the end of this year.
Okay, excellent. And so you mentioned silver as well and how investors might be opting for silver with high gold prices, especially if they have smaller budgets. When you take a step back, it seems like there is some wisdom there. I mean, we see gold has taken off and silver is still around, $32, whatever the case is. And I feel like this also applies, generally speaking, to industrial metals in general. With real estate and the stock market being quite expensive, it seems like, industrial metals, even though we may be facing a recession, still seem like an attractive choice from a value point of view. We still have copper below $5. We have lithium at $9 a kilogram after being near 50. We have nickel at $7. What do you think about, say, silver and industrial metals in general, if we can be so general, about this notion that there is value there in the long term?
Well, there's several things. And first off, I think you have to be very careful. You have to watch out for what we call the Enron syndrome. And you've seen it with other things, Bear Stearns, and as Enron was devolving and heading toward insolvency, there were any number of people who said, oh, wow, Enron, it's off 40%. This is a great buying opportunity. And I think that lithium is sort of like that, too. I think $50 was totally unsustainable. $9 may be sustainable, But you have to look at the fundamentals, and you have to look at the fundamentals for each metal. So we're probably more bullish on nickel and copper and silver, but we're probably more bearish on lithium and some other metals too. You have to really look at them. And just because the price has fallen 80%, doesn't mean that the price is going to rebound. What goes up might come down, but what goes down doesn't necessarily have any reason to rise again unless it's a rubber ball, right? So I think you have to be very careful about saying, oh, these things have come off sharply in prices, they represent a buying opportunity. It may be that the higher prices represented a selling opportunity and a speculative bubble has popped, and it's not necessarily wise to go back. The other problem, the thing to point out is there's the price, and it applies to fabricators and industrial users and processors. But when you get into being an investor, you're not going to be investing in physical copper or zinc or lithium. I mean, some people do that, and every so often we'll get a call from somebody who says, "Hey, I've got X, pounds of germanium in my garage that I bought when the germanium price was very high, and I'd like to sell it, but no one wants to buy it." But most investors say, well, yeah, lithium might be cheap and might be worth buying, but how am I going to buy lithium? I'm going to buy lithium equities, right? Because buying physical lithium and storing it in the garage doesn't make sense. Same is true with zinc and nickel and copper and other metals. Gold and silver, platinum, palladium, smaller. You can buy a little safe, put it in your basement. But industrial commodities are owning direct ownership is very difficult. There are some commodity funds that have been created, and there's some commodity ETFs, but they tend to be extremely small. So we saw, like when the copper price came off a month or so ago, there were people in the market saying, well, it's, the sales of copper ETFs. But if you looked at the volume of sales of copper ETFs compared to, say, the volume of trading on the LME or the COMEX copper contracts, the ETFs were a very small part of it. Those are really professional markets trading at the LME or other places. So for investors, I mean, Northern Miner, I think most of your readers are probably mining people, and the prices of these metals make sense because they're involved in the physical market. But for investors, industrial metals are very difficult to have direct ownership of.
And zooming in on silver just a little bit, I mean, what is your sense of the value there? I remember the last time we talked, you mentioned that gold was basically the play, going for the next year because of perhaps recession. And so how do you see silver, though, from a value perspective, in the sense that we've seen gold taken off and silver just seems to be, consolidating sideways?
Yeah, we're bullish on silver as an investment. We do think that the price of silver probably is going to rise, and perhaps rise significantly over the next year or two, possibly to new record quarterly and annual prices, surpassing the prices that they reached in 2011, 2012. It has lagged gold, partly because it's an industrial metal as well as a financial asset. And on an industrial side, the prices above $28, $28, $30, $32 today, you're seeing industrial users scale back their silver per unit demand as much as possible because of the higher prices that you're already seeing. In addition to that, when you start looking at who buys gold and who buys silver as investors, as I said earlier, related to gold, everybody's been buying gold around the world. With silver, there are silver investors in the Middle East and in Europe and in Latin America, but the bulk of silver, physical silver investment demand occurs in North America and South Asia. So you have any number of people around the world who say, I'm worried about the economic environment. I'm worried about global and domestic politics. I'm worried about financial market stability. I want to buy gold. There are fewer people who say, I'm worried about all those things. I want to buy silver. And I think that that's what you're seeing in the silver price lagging the gold price. So, the gold silver ratio has gone from 80 to 1 to 100 to 1. And I think that that reflects the fact that more people in more parts of the world see gold as the go-to safe haven financial hedge, currency hedge, inflation hedge, protection against political and economic problems than see silver. So I think that that's what you're seeing there.
Okay, very interesting. A little nugget for those that stay to the end. And so just as we wrap up here, Jeff, any final thoughts, big picture for listeners on the gold and silver market? Any advice?
Well, I think the biggest piece of advice I can give right now is, we've seen the prices rise very sharply in the first 4 months, especially in April. The prices have come off since April, but they still are at very high levels, both for gold and for silver. Silver prices have lagged gold, but they're still at very high levels for silver prices, $32 an ounce, $33 last week. And there may be people who say, oh, this is the peak, I'm out of here. But our major message that we would give them is no. If you look at why these prices rose, you started this interview like, hey, who sets the price of gold? And if you say, well, it's who sets the price of gold and why are they buying it? And the same is true for silver. They buy gold and silver as investments primarily because they're worried about the economic and political environment and financial market stability and political problems domestically and internationally. None of those things have really gone away. They're looking a little bit shinier and hopeful today and Friday, but that can dissipate quickly. And we think it will, because all of those financial, economic, and political problems that have caused investors to pour into gold and silver over the last several years, they're still in place, if not worse than they were a year ago.
Jeffrey Christian, managing partner at CPM Group, thank you for joining us and sharing your insights on the Northern Miner podcast. Thank you once again to E3 Lithium for sponsoring this week's episode of the Northern Miner podcast. And thank you once again to Jeffrey Christian for appearing on this week's podcast. And thank you, dear listener, for continuing to support this program. If you want to help out the podcast, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.